Hey, what's up guys? John here. We're going to be walking into an 8% mortgage, a 9% or a 10% 30-year fixed rate mortgage. Many people would say that's impossible. In fact, many people believe that the economy is going to start to see, a soft landing. Some people believe we're going to go back to a 3 or 4 or 5% interest rate. I do not think that's happening. I personally think over the next year or so, we're going to see elevated interest rates, and I think we're going to start to see more defaults on home loans, commercial properties, credit cards, auto loans, and everything in between over the next year or so. And in this video, I'm going to walk you through exactly what's going on so you can prepare for it and you can get ready, because I believe we're going to be stepping into a once-in-a-lifetime opportunity to invest. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on. If you have bad credit, if you need help fixing your credit, we would love to help you. We specialize in helping new investors fix their credit so that they can invest, get the best possible financing. So 561-430-5900. That's where you can reach us for a free consultation. That's 561-430-5900. And the website is GreatCreditFast.com. That's GreatCreditFast.com. Take a look at this. Mortgage rates rise for the second consecutive week, pushing more potential home buyers on the sidelines. Now, mortgage rate for an average credit score in America, the average credit score is a 698. It's a 7.654%. Now, 12 months ago, that was 3.22% for that same exact borrower, that same borrower profile between 680 and a 699 credit score. Now, if you have perfect credit, 740 and above, you're almost 7%, 6.961%. If you have bad credit, 640 and below, you're basically 8%, 7.904%, right? So on the average home in America, $429,000 property, 20% down, so you have to have $85,000 in cash as a down payment at 7.654%. So the average credit score in America, it's $2,900 a month. $2,900 a month. Now you can find an apartment to rent almost anywhere in America for less than $2,900, unless you live in Manhattan, or if you live in Los Angeles or one of these very, very, very expensive cities. You're going to be able to find, maybe even rent a small house for that same money, maybe less, and you want to put $90,000 down, hypothetically, right? Or $80,000, $85,000, $90,000 down. But some really big curveballs are coming. Look at Florida, for example. Florida's property insurance rates expected to jump 40 to 50% in June. That's huge. Now, many people say that's just Florida, John, but take a look at what's happened in the last 2.5 weeks. Ohio, South Carolina, Texas, Michigan. You start to look at all these events that are unfolding, you're going to start to see massive, massive claims to insurance companies, asking for damages, asking to relocate, to move. People are going to start having accidental fires. They're going to try to do whatever they can do to get money from that property to get out from underneath of it, right? Because many people have really good insurance and they want to exercise that insurance. And if something happens, like a fire happens to their property or something, they're going to want to get paid out so that they can take that money and leave. And we're going to start to see thousands and thousands and thousands of claims, maybe even farmers that are impacted. We're going to start to see a lot of risk being held by insurance companies. And what are they going to do? They're going to jack up their rates nationwide. So a lot of places that were most likely affordable may start to see price increases on property insurance, right? And so this is all going to have a really, really big impact on buyers' affordability. If someone is affording this mortgage right here for $2,899 per month, and they're bringing in, say, $10,000 per month at their job, that's a lot, $120,000 a year. If their insurance continues to skyrocket and now energy bills are getting out of control, soaring energy costs could push 141 million into extreme poverty. They say energy price hikes caused by the crisis in Ukraine have also resulted in the increased cost of necessities like food compared to a year ago. In the U.S., the prices of eggs went up 70%. Margarine, 44.7%, butter, 26%, flour, 20%, bread, 14.9%, sugar, 13.5%, milk, 11%, chicken, 10.5%. Together, fruit and vegetable prices increased 7.2%, according to the inflation data released by the Bureau of Labor and Statistics this month. And on Thursday, the CEO of Nestle, the world's largest food group, echoed other consumer giants like Unilever and Procter & Gamble to warn that the price of staple items will rise further this year. Like all of consumers around the world, we've been hit by inflation and now we're trying to repair the damage that has been done, Nestle CEO said on a call on Thursday. Though he declined to say which of the company's 2,000 brands, which span frozen foods, baby formula. We're going to start to see costs continue to rise. And as that's all happening, Jerome Powell says he is going to further increase rate hikes. Jerome Powell is going to further increase rate hikes. And they're also now saying that UC San Diego model predicts housing prices to fall as much as 18%. So you have a lot of people that believe that the economy is going to be fine, we're going to have a soft landing. You have a lot of people that think the housing market is going to crash. I'd just remove all of that from the equation and just look at the core fundamentals. People's income, it has not risen over the last year or two. Yet the cost of everyday life, everything is much, much more expensive. Many people would argue inflation's 15 or 20%. So if you have the cost of living skyrocketing 15 or 20%, you have insurance costs skyrocketing, and now you have what was an affordable debt, maybe a credit card debt, maybe student loans, maybe an auto loan debt, a debt that was once affordable at a low rate, now rates are skyrocketing. It's just going to get much, much more expensive. So the everyday American, it's costing them 20, 25, 30% more just to live. And you look at these huge property valuations that have, been founded over the last year or two, they're not sustainable at these much higher, elevated prices and with all this uncertainty. There's just no way. And now they're saying job reports show increase of 517,000 in January, crushing estimates as unemployment rate hit a 53-year low. So I do not believe that number at all, but 53-year low unemployment, I don't know, every small business that I see, at least a lot of them have for rent signs, right? It's very, very hard to find affordable labor in this expensive world, right? For small business, if you're a large corporation, it might be different. Look at Blackstone. Blackstone's one of the largest landlords in America. They founded Invitation Homes in 2009. They owned 100,000 single-family homes. They're now putting I think it's 600 units, 637 units in Chelsea, Upper East Side, and Mid-South into servicing because they might not be able to make payments because of interest rates elevating so much. Jonathan Gray, who heads the real estate division for Blackstone, says the market's too optimistic, predicting a weaker economy. Says that the world is in much better shape than in 2008. Now, Jonathan Gray is an extremely intelligent man. I don't agree with that. He says that the world's in a much better spot. I look at what the world's been, the change that's happened in the last couple of years. The world's never been worse in the last couple of years. So in 2008, 2009, sure, there was a lot of leverage in the market. Sure, there was a ton of bad loans. Sure, real estate was very, very overvalued. But when we look at what's happening right now, we're seeing a structural shift in the entire world. So to say that the world's in a much better spot now than it was, I don't think so. It might be for the 1% or for the for the very wealthy, like where he is. But for the everyday American is in a much worse spot today than they probably were 15 years ago. Treasury yields more than 5% for the first time since 2007. Even CDs, 4 to 4.75%. So if you look at that, compared to investing in multifamily real estate, like a lot of people were investing over the last year or so, buying a 4 cap. A 4 cap means if you were to buy a property all cash, a commercial property all cash, your return, your net return would be 4%, meaning $1 million property, you make $40,000 a year on that return, right? Now, you can do the same thing now. You can put $1 million in CDs and you could make $47,500 a year, right? It's huge numbers. You can throw the same thing in treasuries, in many treasuries, and receive similar returns than you would investing in real estate. So the big question is, why would you invest in commercial real estate and take on a 3, 5, or 7-year loan term and then not know where rents are going to be, where the economy is going to be, know where interest rates are going to be, take on all that risk for the same return? You wouldn't, right? You would only likely do that if the risk was much lower than the upside reward, right? If you could find deals where you're getting a 7 or an 8 or 9% return, that would obviously be worth, depending on the area, of course, depending on the deal, that'd be worth the risk because there's an upside there. There's an opportunity there to take in, to take that risk in. But now we're going to start to see all of this change as these commercial property owners start to, walk into an era where they're going to have to refinance in these into these higher rates if they can. And if they can't, they're going to be walking away from their properties. Insurance rates are skyrocketing, energy bills are skyrocketing, and likely defaults are going to start to come. Because what are tenants going to likely default on? They're going to default on credit cards, which is what I'm going to talk about now. I mean, you even look at like KKR, the biggest funds, BlackRock, they were halting withdrawals. But if you look at where consumers are. U.S. consumer credit card debt now totals nearly $1 trillion. A trillion. In 2007, it was $828 billion. So we're up 13%, 14%. And this number is just every month, it just gets so much bigger. Household debt hit record $16.9 trillion last quarter as consumers loaded up on credit cards. Now, what I would suggest doing, if you do have credit card debt, is to do a balance transfer. I mean, bankrate.com, for example, they have 11 best balance transfer credit cards, a 0% intro APR for 12 to 21 months. There's a lot of different credit cards, a lot of really good credit cards that offer these balance transfer options. You want to go ahead and shop around and make sure that you have, the best card for you. You want to look at your credit score. You want to look at the perks, the bonuses, how the points work, how everything is structured on each card. And don't go apply for all these different credit cards at one time. I would do your homework and spend an hour, go through all these cards. If you have high interest credit card debt, apply for the card which you're going to have the highest probability of getting accepted to and the one that matches your spending. And then do that balance transfer and get on an aggressive pay down schedule to get out of high interest credit card debt. Because the credit card debt is going to be, I think, the straw that breaks the camel's back for many Americans. Because the cost is just going to be so high as rates continue to rise. And if the income's not following it, and you're not able to make bigger payments than the minimums, you could end up borrowing $10,000, paying back $35,000 or $40,000 over 12 years. Right? It doesn't make any sense. But some of these cards will allow you to do a balance transfer all that money, and then maybe make $800 a month in payments, and inside of a year you're out. Maybe a year and a half you're out of debt. Maybe you rent out a room inside of your apartment. Now, I'm not saying that's going to be a solution for everybody, but I'm simply saying I think it's time for a lot of Americans to buckle down for turbulent times, because I think that these turbulent times, they're going to be coming. There's just no way around it. I mean, how is the average home in America, $429,000 home, nearly $3,000 a month, not including utilities? I'm seeing all these different headlines nationwide of people talking about $700, $800, $900, $1,000 utility bills. You add all this up. I mean, who has $3,500 to $4,000 a month? School teacher, a bus driver, an everyday American working in a basic job, an everyday American middle class job? No, right? You have to make $100,000 a year. This is basically saying that the average accountant, the average American is an accountant, right? The average American is a working class, college educated professional that has no credit card debt and $100,000 cash in the bank. It's just not true, right? We're going to start to see a problem as well when we see these layoffs continue to likely pick up. Over 100,000 tech jobs were lost so far in America in 2023. We're going to see a problem when people can't refinance their properties. When they can't refi and take money out, people are going to be forced to walk away. So again, this is the moment to look at balance transfer options if you are in high interest credit card debt. This is the moment to fix your credit. This is the moment to sit on cash and to prepare for huge opportunities, because I believe huge opportunities are going to be coming to this economy for smart and savvy investors. What do you think about it? Drop below, hit the like button, subscribe here. I'm on my second channel, interactive call-in show and a podcast. And again, if you'd like a free credit consultation, GreatCreditFast.com. That's GreatCreditFast.com, or give us a call at 561-430-5900. And for short form content, click any of the links inside of the banner. Catch you guys in the next video.